Like many enterprises in the global economy, all global companies are affected by changes in the value of currencies on the foreign exchange markets. Foreign exchange fluctuations can have a fundamental impact on sales, profits, and strategy of an enterprise. For the global leader, it is very important to understand how the foreign exchange works and what the impact of changes in currency exchange rates might be for a company. When two parties agree to exchange currency and execute the deal immediately, the transaction is referred to as a spot exchange. Spot rates change continually, often on a second-by-second basis, and are a reflection of supply and demand for the two currencies. The foreign exchange market is not located in one place, as it is a global network of banks, brokers, and foreign exchange dealers connected by electronic communications. One thing to note is the foreign exchange market never sleeps. The primary markets of Tokyo, London, and New York are all shut down for 3 hours. However, secondary markets like San Francisco and Sydney, Australia, are open during those 3 hours. Another key feature of the foreign exchange market is the role of the U.S. dollar as the primary currency, followed by the euro, the Japanese yen, and the British pound sterling. Although a foreign exchange transaction can involve any two currencies, most transactions involve dollars on one side. This is true even when there is a need to sell a non-dollar currency and buy another non-dollar currency. For example, a company wanting to sell Japanese yen for Brazilian reais may find it more cost advantageous to convert the Japanese yen to U.S. dollars and then simultaneously sell the U.S. dollars for Brazilian reais. In converting a currency, there are two numbers, the bid or buy price and the ask or sell price. Let's look at that more closely. If I want to buy 1,000 Japanese yen, it will cost me $8.33. Then I may decide that I do not want the Japanese yen. I then sell the same amount and will receive $8.13, resulting in a 20-cent loss. The difference is known as arbitrage, and this is how the traders make their profit. But what about the need to purchase forward currency for some date in the future? So let's discuss the forward exchange rate market. There is a need to convert 1 million Japanese yen into U.S. dollars in 6 months. Today, if I had the Japanese yen, I could convert to U.S. dollars using the spot rate, which would convert to $8,333 on a spot basis. But that is not an option. So the choice is to do nothing but wait and convert at the spot rate on the day I have the Japanese yen in hand, or execute a 6-month forward contract to sell Japanese yen for U.S. dollars. The decision is made to execute a forward foreign exchange contract by selling 1 million Japanese yen for U.S. dollars to be received in 6 months. This amount to be received would be $7,692. However, if it is decided not to execute a 6-month foreign exchange contract, then the Japanese will be converted to U.S. dollars at the spot rate on that date. Let's see what happened if the Japanese yen weakened against the U.S. dollar. First, we talked about the decision to execute a forward foreign exchange contract by selling the 1 million Japanese yen for $7,692 to be received in 6 months. However, if it is decided not to execute a 6-month forward contract, then the 1 million Japanese yen will be converted to U.S. dollars at the spot rate on that date. 6 months later, the spot rate for Japanese yen is 137 Japanese yen to the U.S. dollar, resulting in $7,299. The decision to execute a forward foreign exchange contract resulted in receiving $393 U.S. dollars more than the spot rate. So view the forward foreign exchange contract as an insurance contract against the possibility the transaction could become more unprofitable. A global capital market benefits both borrowers and investors. It benefits borrowers by increasing the supply of funds available for borrowing and lowering the cost of capital. It benefits investors by providing a wider range of investment opportunities, thereby allowing them to build portfolios of international investments that diversify their risk. The global bond market has grown rapidly over the last 4 decades. Bonds are an important means for financing for many corporations. There are 2 types of bonds: foreign bonds and euro currency bonds. Foreign bonds are sold outside the borrower's country and are denominated in the currency of the country in which they are issued. Many foreign bonds have nicknames. U.S. bonds are known as Yankee bonds. Great Britain bonds are known as bulldogs, and Japanese bonds are known as samurai. Euro bonds are normally underwritten by an international syndicate of banks and placed in countries other than the one in whose currency is denominated. For example, a bond issued by a German company, denominated in U.S. dollars, and sold to investors outside of the U.S. by an international syndicate of banks. The attraction of the Eurobond market is 1. An absence of regulatory interference. 2. Less stringent disclosure requirements than most domestic bond markets. And 3. Favorable tax status. Substantial regulatory barriers separate national equity markets from each other. Regulatory barriers made it difficult for a corporation to attract significant equity capital from foreign investors. Those barriers tumbled rapidly during the 1980s and 1990s. The global equity market has enabled firms to attract capital from international investors, to list their stock on multiple exchanges, and to raise funds by issuing equity or debt around the world. An interesting consequence of the trend of international equity investment is the internationalization of corporate ownership. Today, it is still possible to talk about U.S. corporations, British corporations, and Japanese corporations, primarily because the majority of stockholders in these corporations are of the respective nationality. However, this is changing as U.S. citizens are able to buy stock in companies incorporated overseas and vice versa, as foreigners are buying stocks in companies incorporated in the United States.